Welcome to vTalkInsight, Market Drivers Daily for July 2nd, 2026. AI leaders are suddenly facing questions about overcapacity just as U.S. growth stays resilient and central banks debate how long to keep rates elevated. These shifts in AI, growth data, and rate expectations are intersecting in ways that could reshape equity leadership and volatility across asset classes. AI is still the dominant equity and macro storyline, but the tone has shifted from straightforward scarcity and momentum to a more complicated debate about capacity, profitability, and policy risk. Recent moves across AI hardware, cloud, and software show a market trying to distinguish durable cash flows from more speculative promises, rather than rewarding anything with an AI label. Meta's reported plan to rent out excess AI computing power has become a key catalyst. Its own shares jumped on the prospect of monetizing idle data center assets. Yet the same headlines hit chipmakers and smaller cloud providers, as investors read them as a sign that hyperscaler capacity may already be ahead of demand. South Korean names such as SK Hynix have fallen sharply. The Kospi is under pressure, and the chip sector globally has seen double-digit declines over just a couple of sessions amid worries about custom chip developments and shifting partnerships. Liquidity looks thin across the AI complex. Market depth in key tech names appears shallow. Hedge players and fast money are de-risking, and mechanical rebalancing flows from leveraged exchange-traded products linked to stocks like SK Hynix are amplifying both rallies and drawdowns. Under the surface, though, the picture is more nuanced. Major AI platforms are now generating substantial and rapidly growing revenues, which differentiates this cycle from earlier episodes when valuations ran far ahead of business performance. Large compute and data center projects are already supporting suppliers across construction, equipment, and local services, even as some worry that Meta's excess capacity highlights the risk of misallocated capital. Policy and politics add another layer of uncertainty. The White House is accelerating work on AI model standards, but federal oversight still relies heavily on voluntary commitments. At the same time, the administration is exploring taking around a 5% equity stake in firms such as OpenAI, signaling deeper government involvement in the sector's upside. Locally, communities worried about power usage and land are pushing for new taxes or moratoriums on data centers, and increased scrutiny has already slowed the release of some advanced models. Many market participants expect the AI story to evolve over the next 6 to 12 months from demand-driven and potentially inflationary to one centered on productivity gains and disinflation as model and compute costs fall. For now, the takeaway is that AI still anchors the structural growth story, but with rising dispersion between infrastructure providers, model platforms, and downstream applications, setting the stage for the broader growth dynamics we see in the real economy. Turning to growth, the macro backdrop looks more resilient than some recent headlines suggest. The latest U.S. payroll report undershot earlier forecasts, but construction employment surged, reflecting a powerful onshoring and factory-building trend. Over several months, jobs growth has consistently cleared 100,000 per month. 3-month averages have moved above 180,000, and activity data point to real GDP running near 3%, consistent with a soft landing rather than a downturn. A historic construction boom is underway, supported by favorable expensing rules and industrial policy. Strong factory construction and manufacturing activity are driving robust job creation, and new facility groundbreakings are at unprecedented levels, giving visibility on future employment as projects come online. AI-driven capital expenditure is a core part of this story. Large data center and compute projects are creating a cascade of demand through local suppliers in power, real estate, and services. At the same time, some analysts warn that heavy tech investment may be crowding out more traditional factory building, potentially under-resourcing parts of the broader economy over the medium term. Corporate earnings are reinforcing the growth narrative. U.S. earnings are tracking close to 20% growth, and indices such as the Russell 2000 have pushed to new highs, signaling renewed risk appetite. Cyclical sectors including industrials, energy, materials, and semiconductors are expected to benefit from strong nominal GDP and still look attractively valued relative to the broader market. Mergers and acquisitions are robust, with almost $2.8 trillion in announced deals focused on growth and synergies, while infrastructure and digital infrastructure spending is projected to exceed $1 trillion annually, making these areas dominant issuers in investment-grade credit. Household behavior remains a swing factor. U.S. consumers are sustaining spending despite higher prices by cutting savings rates, which supports near-term growth but leaves balance sheets more vulnerable to future shocks or higher unemployment. On the labor side, companies investing heavily in AI are actually expanding entry-level hiring in engineering, sales, and finance, suggesting AI adoption is currently associated with higher output and more hybrid roles, not broad job losses. The risk side of the ledger includes the possibility that AI infrastructure has been overbuilt, that tech capex displaces other forms of investment, and that stretched consumers eventually retrench. How that growth mix interacts with central bank reaction functions is now critical, bringing us to the policy backdrop. The rate story is increasingly about how long policy stays restrictive, rather than how many additional hikes are left. Markets are still pricing roughly 30 basis points of extra tightening by year-end, but expectations for the next Federal Reserve move have slipped from October toward December after a softer payroll print and a bull steepening in the curve. Some forecasters even expect the Fed to remain on hold through 2027, while others see room for multiple hikes, underscoring how uncertain the path remains. Elevated real yields, with 10-year inflation-linked bonds above 2%, are already tightening financial conditions even without fresh policy action. Labor data sit at the center of that debate. Recent months have seen frequent upside surprises in payrolls, but the latest report disappointed, highlighting just how noisy the series has become. Markets are increasingly focused on wage growth and the breadth of job gains rather than the headline number. Wage growth has been trending lower. There are no clear signs of wage price spirals or profit-led inflation. And some analysts argue that without a broad acceleration in pay, multiple additional hikes will be hard to justify even if growth stays firm. Globally, central banks remain cautious. The European Central Bank keeps a hawkish bias despite softer oil prices, warning that core inflation could stay above target for 2 to 3 years, so markets may be underestimating the chance of another hike. In Japan, an undervalued yen, instability in government bonds, and hints of more hawkish Bank of Japan guidance pose spillover risks to U.S. rates, especially in thin liquidity conditions. Across major economies, policymakers are less inclined to step in quickly to support equity markets, while inflation is elevated and volatile, meaning drawdowns are more likely to run until they threaten the broader economy. Liquidity withdrawal tied to persistent inflation is already undermining support for risk assets, including in structurally strong areas such as memory chips, and the Fed's lack of detailed forward guidance is adding to rate and equity volatility. AI complicates the outlook further. On one hand, AI-related demand is contributing to higher prices for data centers and software and could support arguments for keeping rates restrictive. On the other, positive supply shocks from AI-driven productivity and factory construction are boosting output without clear evidence of second-round inflation effects, which could reduce the need for aggressive tightening over time. The balance between these forces will shape not only policy rates, but also the relative performance of AI-heavy growth assets versus more cyclical parts of the equity and credit markets. To wrap up, AI remains the structural growth engine, but is moving into a more discriminating phase, with questions around capacity, pricing power, and regulation driving sharp dispersion within tech and semiconductors. Growth data still point to a soft landing supported by AI and infrastructure capex, strong construction, and solid earnings, even as consumers run down savings and some investment is potentially being misallocated. Central banks are signaling a high for longer stance, with wages and core inflation now more important than headline jobs for the timing of any further moves, and with less willingness to backstop equity drawdowns. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.